Central banks are probably the most powerful institutions you've never been told to question. They rarely make the news. They don't run for office. Most people couldn't explain what they actually do if you asked them, but these institutions quietly control the value of your money, the health of your economy, and the real worth of everything you've ever earned. They can create wealth out of nothing, or wipe it out just as fast, and the strangest part, they don't answer to you or me. This is the story of how central banks came to run modern finance. Not as neutral referees enforcing fair rules, but as active players in a game whose basic rules they wrote themselves. A story about hidden power, financial engineering, and a carefully maintained illusion of stability. Once you understand it, you'll never look at your paycheck, your debts, or your savings account the same way again. Let's go back to 1694. England was completely bankrupt. The royal treasury had burned through much of its wealth fighting France, and the coffers were empty. So the Bank of England was founded, and here's the point, most people miss this. Bank wasn't created to serve ordinary people, it was created to lend money to the government and profit from doing so. That's the origin story of the modern central bank, not a stabilizer, a lender to the state, and from there, the power only kept growing. By the 1800s, central banks had spread across Europe, all running essentially the same playbook, privately owned institutions with privileges baked in. They issued currency-held reserves and bailed out governments when things got messy. In return, they accumulated influence that operated almost entirely outside democratic oversight. America took a far rockier road to get there. Americans were genuinely skeptical of centralized financial power, and honestly, they weren't wrong to be. The first and second banks of the United States were both shut down after ugly political fights over corruption and elitism. For most of the 19th century, the country had no central bank at all, and the financial system was chaotic. Private currencies everywhere, speculative bubbles, bank failures, panics. Then came 1907, a crisis so severe that a single private banker, J.P. Morgan, had to personally step in and coordinate the rescue of the entire system. That scared enough people into action. In 1913, Congress passed the Federal Reserve Act. The pitch was a decentralized network of regional banks that could keep the economy stable. What emerged in practice was a central authority with enormous control over interest rates, credit, and the money supply. And here is where it gets interesting. The Federal Reserve is not a government agency. It's a strange hybrid, part public, part private. The board is appointed by the president, but the member banks are privately owned. It doesn't run on tax dollars. It runs on interest from government. Debt and fees charged to banks. It operates deep within financial markets, making decisions that affect millions of lives with virtually zero voter input. So who is it actually working for? Officially, the Fed has two mandates: keep employment high and keep prices stable. But if you watch what it actually does, the pattern is pretty consistent. Its actions tend to serve the interests of the very institutions it's supposed to oversee. In 2008, the Fed didn't just cut rates, it printed trillions. It bailed out investment banks, it propped up asset prices and backed toxic debt. In 2020, it did the same thing. Corporate bond purchases, liquidity injections, inflating asset values. Great for those who already owned assets. Not much use for those who didn't. That's the core of it. Central banks don't just manage the economy, they shape it. They quietly pick winners and losers. When they cut rates, stock prices rise. When they tighten, markets shake. When they print money, asset owners get richer. When they raise rates, ordinary people pay more for mortgages, car loans, and credit cards. Despite wearing the badge of independence, central banks are deeply entangled with the very financial system they're supposed to oversee. Their leaders revolve in and out of investment banks. Their policies tend to align with what Wall Street wants, and their communication style, deliberately technical, dense, wrapped in academic language, has the convenient effect of keeping most people from ever engaging with it. Right now, central banks are more powerful than they've ever been. The Fed, the European Central Bank, the Bank of Japan, the Bank of England, these are not background institutions. They are the architects of our monetary reality, and since 2008, they've transformed the economy into something that would have looked completely alien 20 years ago. Near zero interest rates became the new normal. Quantitative easing, once considered a last resort, became routine policies. Central banks printed trillions to buy government bonds, corporate debt, mortgage-backed securities. Asset prices surged. Stocks, real estate, commodities. If you owned things, it was a remarkable run. If you didn't, you watched the cost of living climb while your savings earned essentially nothing. Housing became out of reach. The stock market drifted further and further away from real wages. Most people were confused about why blaming politicians' bad luck or whatever was in the news that week, not the invisible hand quietly steering the money supply. Here is the uncomfortable truth: the modern financial system was not designed to set you free, it was designed to keep you moving. Central banks grease the wheels of consumption, they reward debt and punish saving. They manipulate rates, manage narratives, and move trillions with a few keystrokes. And every single intervention, every emergency meeting, every press release, every liquidity injection gets framed as stability as protection. But it's not your stability they're protecting. When things fall apart, the central bank steps in and saves the system, not you, the banks, the asset holders, the financial architecture. Look at 2020. Markets collapsed at a speed no one had ever seen. Within weeks, the Fed pumped out over $3 trillion in new liquidity. Stock markets recovered. Billionaires came out richer than before. Meanwhile, millions of workers lost their jobs. Small businesses that had been fighting to survive for years shut their doors for good. Renters faced eviction. What was saved wasn't the economy, it was the illusion that everything was fine. And this has real consequences for your life. When central banks distort the cost of money, everything downstream gets distorted too. Pricing risk becomes harder, saving becomes pointless, retirement starts to feel impossible, bubbles form, crashes follow. And through all of it, most people don't even realize they're being affected. They can't connect the interest rate on their student loan, the return on their savings account, or the price of the house they're trying to buy to decisions made in rooms they'll never enter by people they'll never vote for. So what do you actually do with this? You can't dismantle the system, but you can stop being blindsided by it. You can own things that can't be printed. You can build income streams that don't depend on a debt cycle running forever. You can deleverage, simplify, and think carefully about what you actually own versus what you owe. Most importantly, you can see clearly. Central banks are not gods, and they are not neutral. They are players with tools, interest rates, asset purchases, liquidity programs. And those tools were not designed with your financial freedom in mind. They exist to keep a fragile, debt-fueled machine running. Once you understand that, you can start making decisions from outside the trap instead of inside it. Because when the next crisis comes, and it will, the central bank will do exactly what it always does. It will protect the system. Protecting yourself will be up to you.